Hello my friends, you're looking at my chart, my S&P futures chart of Tuesday, August 1st. Now, as I'm making this video, it's almost the end of the month of August, and I want to go back all through the month of August and show you the tools that I use to trade and prove their value to you. Now, this is my chart as I set it up every day. Now, to give you a frame of reference, this is a 5-minute chart, and there are 10 points between each horizontal line on the chart. And what you see on my chart and what you're looking at is my Taylor trading zone, the trading zone that I put on my chart every day based on the Taylor calculations to give me an indication of where the market is likely to trade. I also have the previous day's close that I draw out on the chart as a horizontal line. The third thing I have on my chart are the stochastics at the bottom, or I should say is the stochastics at the bottom. So that's it. And these are the only features that I have on my chart. I don't use any other indicators. In my last video, I spoke a little bit about AI, or artificial intelligence, and how traders are trying to use it to make money in the market. And let me suggest to you, and I'm going to repeat what I said in that video, that artificial intelligence is not going to help you. What is going to help you is real intelligence. And so this video is about real intelligence that you need in order to be a successful trader. So let's go into it. Now, the first thing that I pointed out on the chart was the trading zone, the area where prices were most likely to trade on any given day. And I get that information from the Taylor trading technique, or the Taylor book method. The Taylor trading technique is a series of calculations, and there are a dozen calculations that go into it, and it comes down to an average of averages. And the calculations boil down to just two numbers, a support number and a resistance number. And I've just filled in my calculator to give me the information for the next trading day. And for Monday, August 28th, the resistance is going to be at 44.30. The support is going to be at 43.65, and there's going to be a 65-point calculated range between those two numbers. Okay, so I've just given you the trading zone for Monday, August 28th. Back at my chart, here's the chart of August 1st. Now I'm going to scroll through this chart each trading day up to the just finished trading day, which is August 25th. And I want you to notice how many times prices traded within the trading zone and how many times they hit the gap, okay? And I'm just going to do this relatively quickly, but you're going to notice that the prices where there was a gap trade, the gap failed only 20% of the time. Actually closed where there was a gap trade, almost 75% of the time in these next 19 trading days that I'm going to show you. Also, you're going to notice how often that prices traded within the Taylor calculated trading zone. So let's go. Beginning on August 1st, a Tuesday, here we are. And on Tuesday, prices traded within the trading zone. On Wednesday, August 2nd, prices didn't trade in the trading zone, nor did they trade anywhere near the trading zone, okay, in anticipation of an announcement. And this is the only day where prices faded the trading zone and the gap completely, okay? So, moving forward, here we go on August 3rd. Prices traded within the trading zone. There was a gap trade that filled. August 4th, prices traded within the trading zone. There was a gap trade that filled. August 7th, prices traded within the trading zone. No gap trade, but prices traded within the trading zone. On August 8th, prices traded outside the trading zone, then came back up into it. And I'm noting the number of points that you could make if you traded just using the trading zone or the possible gap. Okay, here's August 9th. Trading zone was good for 41 points. The gap filled. August 10th, trading zone, prices traded within the trading zone, good for another 40 points. Again, prices filled the gap. August 11th, prices traded within the trading zone. Gap was good for 15 points. August 14th, the gap filled for 9 points. If you held on to the trading zone resistance level, you were good for 20 points. On August 15th, prices traded again within the trading zone. You get out when the prices leave the trading zone because the trading zone is your crystal ball. August 16th, again, prices traded within the trading zone. There was a small gap. Where do you trade this? Do you pass or do you exit the trade? Again, on August 17th, prices traded within the trading zone, did close the gap, good for 12 points. On August 18th, the gap was good for 20 points. Again, prices traded within the trading zone. And August 21st, again, prices filled the gap, was good for 12 points. Prices traded within the trading zone for a brief time, but then exited. August 22nd, again, the gap was good for 19 points. Prices opened up here at 44.30, closed the gap down at 44.11. So good for 19 points. Prices again traded within the trading zone. August 23rd, prices traded within the trading zone. The gap failed for that day. The trading zone trade was good if you entered the gap, if you entered the trade and exited the trade when prices left the trading zone. Trading zone again, it's a crystal ball. On August 24th, prices traded within the trading zone, good for 45 points, did close the gap. And August 25th, Fed chairman made an address at 10 a.m., caused the market to fluctuate wildly at that 10 a.m. point. But again, prices traded within the trading zone, and you could have done very well. Now, how do you use the trading zone? Well, I didn't mention anything about the third thing I have on my chart, which is the stochastics. The stochastics give you an indication of whether to enter a trade. Now, entering a trade is based on a setup. So how do you know what the setups are? Well, you have to take a trading course. You have to learn what the setups are. And my friends, there are only 6 setups, and I teach them in my course: gap, support and resistance, time and price, trend, momentum, and candlestick, GST, TMC. There are only 6 trade setups. So the stochastics give me an indication of whether I should enter a trade, and the setups let me know whether a possible trade exists based on the setup. Now, the last thing that I haven't mentioned is trader psychology. Psychology plays a big part in trading. And if you are trading for a while, you certainly know that. If you have not traded, or if you're trading only paper money or simulated trading, you have an inkling, but you don't really get the message until you're trading real money. You have real money on the line. So psychology, being such an important part of trading, is something that I also talk about in my course. But you have to rely on what you know. You can't rely on artificial intelligence. You have to have the trading zone. You have to mark your chart with the previous day's close. I mean, that's a no-brainer. You should use the stochastic. You should learn about risk, which is, again, I teach in my course as well. And so you have to know the 6 trade setups: gap, support and resistance, time and price, trend, momentum, and candlestick. You have to know what the daily trading zone is, because if prices are not trading in the trading zone, why trade? If the trading zone is the next best thing to a crystal ball, use it together with the price setups, the 6 price setups, and the stochastics to give you an indication of whether the setup should be entered as a trade. So that's my video for today. Thanks so much for watching. Trade safely, use lots of patience, and I'll see you in my next video. Marv Eisen for Timeless Dollar Trading Academy.